Hey guys, thanks for tuning in to my first video on my brand new YouTube channel, The Young Investor's Handbook. I'm certainly excited to start making videos, and I hope you're just as excited to watch them. My motivation for creating this channel is very simple. I've worked in finance my entire professional career, and over the years as I was learning the industry and also learning how to manage my finances, I was also learning that there are a lot of young adults out there that are either really stressed out about money, have no idea where to start, and are just generally apprehensive about investing money or exactly what the steps are involved on how to become financially literate. But the good news is there's really nothing to worry about. That would be my number one piece of advice to anyone looking to get started out there, is that it's really not that bad. Once you get going, it almost just kind of takes care of itself. And just like anything good and worthwhile, there does take a little bit of effort and some diligence on your part. But that's why I'm here, is to give you a step-by-step approach on exactly what to do and how to start generating wealth and let your money work for you and to not be a slave to your finances. And I know you're probably asking yourself, well, what makes you qualified to tell me how to manage my money? And that's a fair question. And the answer is pretty simple. I'm just a guy. I'm not famous. I don't inherently have any better skills than anyone else out there. And chances are a lot of you are making a higher salary than I am right now. But even though I'm just a normal dude, I've learned how to become financially independent to where I don't lose any sleep at night about what my future is going to look like or what would happen if a big unexpected expense pops up. And to me, that's truly the definition of being wealthy, is the fact that you just really don't have to worry about money anymore. So if you stick with me, I promise I can give you a lot of great advice and easy to implement steps on how you can get to that point of allowing your finances to truly be an asset for your life and not something that you're constantly worried about. So in my inaugural video, and the first of what I hope is many to come, I wanted to talk about one of the things that I feel is most important to young investors, and that's starting investing early and allowing time and compound interest to truly work its magic and allow it to grow into the life that you want to live. And I think that's a common goal for anyone starting out in life. That no matter what your situation is right now, you want to continually improve that. And for a lot of us, becoming a millionaire is one of those things that seems so far away that it's impossible to capture. And it's easy to get discouraged and simply stop trying and stop pursuing that goal. But I have a really simple, cheesy story that can hopefully help you understand that by starting soon, it doesn't take very much money, just a little bit of time and effort and diligence to where you can become that millionaire later in life and live the type of life that you want to live. So if you'll bear with me for a couple minutes, I'm going to tell you a story about Jack and Jill. So to start out, Jack and Jill both get their first jobs, and they realize that they need to go to a bank and open up their bank accounts and get a checking and savings account and a debit card and all the things that comes with being an adult. And each paycheck, Jack sets aside a little bit of money each time, and by the end of the year, he has $2,000 saved up. So now Jack goes back to his bank, and after doing a little bit of research, he decides he wants to open an IRA. And if there's any of you out there that are watching and are not familiar with what an IRA is, it's simply an individual retirement account. It's a tax-advantaged account that you can contribute a certain amount of money to each year, take that money, invest it in the market, and later in life you're able to access all the wealth that's generated while avoiding Uncle Sam in the process. So Jack takes his $2,000 into the bank, he opens up his IRA, and through his research he decided he wanted to invest his $2,000 in an index fund that tracks the S&P 500. And again, if you're starting out, I know I probably used a lot of terms that might be unfamiliar to you, but again, these are all easy, and I promise you that I'm going to have videos that explains all of these going forward, so just bear with me. So when Jack invests in this index fund, he knows that the market historically averages about a 10% return. And this is generally the benchmark that financial analysts and college professors and you name it, they use that 10% benchmark because again, we have decades upon decades upon decades of history that tells us that generally investing long-term in the market, you're going to average 10% over the life of that investment. Now, there are going to be years that you do better than 10%, but there's also going to be years that you do worse than 10%. All in all, it'll average out to about 10%. So to get back to the story, Jack invests his $2,000. Jill, on the other hand, she's more concerned about just using her money and spending it on all the things that young adults spend their money on. And she doesn't really value the time and effort that it takes to prepare for her future and to set aside money for her future. And so this trend continues on for the next several years. So you can see here on my super fancy whiteboard, I've illustrated this. Starting at age 19 all the way until age 26, Jack invested $2,000 each year for a total of $16,000 is what he invested up to that point. Now here's the thing, that $16,000 initial investment has grown to give Jack over $25,000 in value in his IRA. So when Jack logs into his bank account to check on the balance of his IRA, he's excited and he wants to run and go tell Jill the good news. And after Jill sees the $25,000 that Jack has in his account, she's obviously a little upset and embarrassed that she wasn't doing the same thing. So Jill decides that she's going to start investing $2,000 each year just like Jack. And so Jill decides to take the same approach, and she begins investing $2,000 at the beginning of each year. Now going back to Jack, he was pretty satisfied with this $25,000 balance, and he kind of sat back and said, you know what, I'm good. I've been doing good for the last several years, and I feel like keeping my money and spending it on whatever. So while Jill was busy investing $2,000 each year, Jack stopped, and he never invested any more money ever again in his IRA. So by the time Jill retired at 65 years old, she had invested $78,000 in her IRA account. And with the value of compound interest, that $78,000 investment has grown to over $880,000. Now I know what you're thinking, that's pretty sweet, right? She invested $78,000 of her own money, and through the power of compound interest in time, that money has grown to over 10 times what she put in herself. So that should be enough of an example in and of itself to help motivate you on how important it is and how much a relatively small amount of money can grow over time. But here's the kicker, and also kind of the lesson in the story. Jack stopped investing after he turned 26 years old, and he never put anything else in there after that $16,000 initial investment. However, that money still continued to grow over the course of Jack's career, and by the time he retired at 65, he had over $1 million in his IRA account. And again, he only invested $16,000 out of pocket way back whenever he was a young adult, and now he has over $1 million by the time he retires. So even though Jill invested more than $60,000 into the market than what Jack did, the fact that Jack started early and he allowed compound interest in time to work on his behalf, he became a millionaire, and it only took him $16,000. Now don't get me wrong, $16,000 is a lot of money for anyone. I don't care what situation you're in. But the point being is that if we're diligent and have the discipline to invest and allow that to grow without touching it, then that 10% average each year really does work wonders on our behalf. So hopefully this silly example will stick with you like it did me. My very first finance professor way back in my freshman year of college gave us this story, and it's stuck with me ever since then, and it's always motivated me that if I can find a way to set aside a little bit of money from each paycheck and invest that, then that power of compound interest in time will work on my behalf by the time I'm retired and ready to access that money. So to put it in perspective, if you have $1,000 right now and invest it in the market, again assuming a 10% average return, by the end of 10 years, your initial $1,000 investment has grown to over $2,600. And that's 2.6 times the amount of money than you initially put in. But if you keep that same $1,000 invested for 20 years, it would grow to over $6,700. So as you can tell, that compound interest keeps growing substantially even if you're not contributing anything additional to it. But check this out. If you keep that same $1,000 investment, after 30 years, you'll have over $17,000 in your account. So here's the thing to remember. Whenever you invest your money in the market and enjoy that 10% average long-term return, that interest rate will help you make money on your money, and then you make money on the money that your money made, and it just keeps going. And finally, just a couple of pieces of advice before I go. Whenever you do get invested in the market, please remember to temper your expectations if you have a year that you exceed that 10% average return. As some of you probably know, we're currently in one of the greatest bull markets that we've been in recent history. In a lot of years, the market returns well above 10%. However, there are also some years where that return is substantially lower than 10% or maybe even negative. But here's the thing, when the market is returning lower than that 10% long-term rate, this is essentially allowing you to acquire more at a cheaper price, which will then generate more wealth later on when that market goes back up to that 10% average. So the thing to think about is almost looking at it like a Black Friday sale. It's that you're able to get these shares for way cheaper than what you could have whenever the market was really doing good. And finally, I've spoken a lot about the 10% average that the market generally returns over the long run. Now that's not guaranteed, and investing in the market always comes with some risk. But again, evidence has shown us time and time again that investing in the market long term, you can generally expect that 10% average. So guys, that's all I got for you today. Again, I appreciate you tuning into my first video. There's certainly going to be more to come, and I promise I'm absolutely going to help you better understand what it takes to generate wealth, especially as a young adult, and to become more financially literate to where your money really starts working on your behalf and truly becomes an asset for you. Thanks again. Until next time.